If you want to see more videos and interviews like this from influential people in tech, finance, and sports, subscribe to the channel and make sure you hit the bell to be alerted. And go a step further and join the YouTube and membership area for early releases of videos like this. I'm out of here. Ha!
You think about it, investing, I believe, is always superior to speculating or gambling, right? In the sense of, if you think about what we do as investors try to buy things today that are below their fair value and that they'll appreciate in the long term. And we take a long-term perspective. Then there are traders, and traders don't really care about fair value. They don't care about long-term. They want to scalp some return from trading. Trading is hard. There are very, very few really good traders, but they exist. Then there are speculators. Now, speculators are interesting. Speculators kind of get a bad rap in that people think of them as the fourth category, which I'll get to, which is gamblers. But speculators are actually an important part of financial ecosystem in that there are people. They
provide liquidity, right?
They provide liquidity. Exactly. They provide liquidity. And they are there to be the opposite side of hedgers. So let's say I'm an oil and gas producer and I'm drilling for oil and I need to sell it in the marketplace. So I sell it in the futures market. I need someone like you to come along and take the other side of that transaction. I'm a hedger, you're a speculator. Not evil, not bad. Now, when people take that construct and twist it a little bit and say, okay, a speculator today is someone who buys something that they don't have any knowledge of. They don't really have any conviction. It's moving. Then the problem is you go to the next level, which is gambling, when you do it with leverage. And the problem with leverage, right? If I buy a house for cash and it goes up 10%, I make 10%. If I borrow half the money, it goes up 10%. I actually make 20%. 10 on 50. If I borrow 80% of the money, like a normal mortgage, and the price goes, I've now made 50%. So you take it to the silly extreme. If I borrow 100% of the money, if some bank will give me 100% mortgage, I get an infinite return. But it goes the other way, right? If price goes down 10% and I own it in cash, I lost 10%. If it's half leverage, I lose 20. If it's 100% financed, I got an infinite loss. So, and I think that's what happens in markets is people start, I'm going to buy something because I think it's undervalued. Okay. I'm an investor. And, then it goes against them. Well, now I'm a trader. Now I'm going to sell, I'm going to buy some more. I'm going to double down. Bad idea. Right. When something goes against you, just move on. Right. Because the market's never wrong. You're wrong. And the problem for most investors or traders is they don't like to be wrong. But here's the problem. If you don't like to be wrong, get another job, right? Get another passion because the best,
you're going to be wrong.
The very best
traders know they're going to be wrong
in the world are right about 58% of the time. Julian Robert. And so most of us are lucky to be right half the time. But as Stan Druckenmiller said, it's not whether you're right or wrong. It's how much money you make when you're right and how much money you lose when you're wrong. So if you can minimize your losses and take losses quickly and just admit you're wrong and move on to the next idea, the gains actually take care of themselves.